And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week. Well, of course, that also means that Michael Lebowitz is here this morning to talk all about the Fed yesterday, which was a snoozer. Said nothing different. So we'll get into all that this morning. A couple other things going on. Of course, we have now pretty much, for the most part, wrapped up all of quarter one's earnings season. And we'll, have a few little laggards coming in here. The big one that's still hanging out there, of course, is NVIDIA. Some good news for NVIDIA, of course, is that the Trump administration announced yesterday that they're going to start working on revising the export ban on chips for China and other countries, and that's going to certainly boost NVIDIA a good bit because they have such a large component of AI chips being bought, of course, just in general. But one of their big outsources to other countries, and those tariffs were going to impair those sales a bit. So that was good news for them. They rallied yesterday on that news, of course. And of course, if the Trump administration does come through with those revisions on those bans, that's going to certainly help NVIDIA, really as much as most of the other companies in the semiconductor sectors, but in particular for NVIDIA, that'll be a big boost. Also, but going back to quarter one earnings, we've now pretty much wrapped that up. For the quarter, after very large revisions, we had about a 75% beat rate overall, above the historical average. Not surprising. Again, we cut earnings estimates, rather sharply. We've had very big cuts for quarter two, by the way. So quarter two is already stacking up to be another good, kind of beat quarter. But the growth rate for earnings came in on a year-over-year basis about 11%. Now that is down sharply from the 19% that was previously expected. When we first started expecting, putting out estimates for Q1, we were around 19% earnings growth, came in at 11, which is it is a little bit above the historical norm if you strip out all recessions. So again, normally around, you get about 9 to 10% earnings growth in a non-recessionary year. That's what you would kind of expect. But again, kind of overall, it was a good quarter one earnings announcement. Now, this weekend's newsletter, we're going to get into earnings because S&P has now just slashed their earnings dramatically for quarter two, really, and going into 2026 as well. They took about $25 off of earnings estimates into 2026 just in the last 15 days. So all of a sudden, there's been this big step back by S&P and earnings. So we're going to go through that in the newsletter this weekend. But that kind of dovetails into the fact that we are seeing, slower economic data on a lot of fronts. Employment data, while it's still good, is slowing. 177,000 jobs are good, but again, much slower than the rate of growth we've been having in the employment data previous to this. So, all that stuff that we talked about previously, that, all that monetary stimulus and everything that's put in the economy that kind of got the economy into overdrive in 2021, 2022, is now slowly fading out of the system. That money is coming out. We're seeing consumer credit, rising as consumers have to turn more to credit just to make ends meet, as all those excess savings are now out of the system. So that's what you would expect, slower demand. The economy is slowing down, and so again, now, kind of Wall Street's having to go, okay, we're going to have to revise estimates now. Now we lay tariffs on top of this. There's potential for even slower economic growth, and slower economic growth is going to lead to slower earnings growth. It's just, that's where earnings come from, so it's going to slow down, and that's what you're starting to see in a lot of these estimates. But we'll go in that in the newsletter this weekend, of course, in more detail, so make sure you're subscribed at the website, realinvestmentadvice.com, for the Bull Bear Report. Links on the front page. If you go to realinvestmentadvice.com, right towards the bottom, there are links to our daily market commentary, the newsletter, daily blogs, our YouTube channel, everything right there. You can get subscribed to all of our free stuff. Keep you up to date with markets and your money. Okay, let's talk a little bit about what you need to know before the bell this morning. Of course, yesterday was the Fed announcement, and again, we'll get more into the actual details of that. But it was pretty much a nothing burger. Nobody expected a Fed rate cut, so it's exactly what they did. They didn't cut rates, and they said, hey, we're going to sit here and wait on the data. It's quite interesting that this time last year, they're cutting rates by 50 basis points with employment stable and, the economy doing okay and inflation coming down. And yesterday we have inflation coming down, employment stable, the economy's doing okay, and no rate cuts. So, what their thesis is for rate cuts or not rate cuts is kind of an anomaly now. I just don't know what they're thinking. So we'll kind of see what happens. But the market responded okay to that. Initially kind of sold off with kind of disappointment about, the lack of a rate cut. But right after that, the markets rallied back into positive territory, finished the day on the upside. So a couple pieces of really good news here for the bulls. We are now bouncing off of support at the 50-day moving average. So we have now tested the 50-day moving average twice over the last couple of days, held that. The market's expected to be up about 1% at the open this morning. So we're going to get a nice little bounce off this 50-day moving average. So we're building some support at that support level right now of that 50-day. At the same time, this 20-day moving average is very rapidly catching up with the 50-day. So we're about to have a double layer of support sitting right below where stocks are trading right now. And if you take a look at systemic traders, the CTAs, the computerized trading algorithms, you take a look at kind of professional managers, they are not grossly long exposure right now. They are either underweight equity exposure or neutral equity exposure, which gives a lot of buying power to the markets. If we start to get some more good news here and if stocks start to rally, that's going to start to suck more money back from defensive positioning back into the market itself. But importantly, what we've got here is, though, you got this kind of support building right around the 50-day, the 20 days catching up here. And we're also building a really good support line along those previous bottoms. So we had that whole bottoming process previously just before the Liberation Day announcements. And then, of course, we just broke down sharply from that when Trump kind of surprised the whole world with the announcement that he made. But prior to that, the market was consolidating, expecting those 10% tariffs to come along. And if that had happened, the markets probably would have been okay. Of course, as the Liberation Day announcement was not that. We had that big sell-off. Since then, the market's recovered on this kind of news. We've been building this nice uptrend line. And so what's happening here is that we've gone back into this consolidation range. So we're building a very nice consolidation range for the markets, and that's going to build a kind of a key level of support here. So the good news for the bulls is if markets can hold this and rally, we're very, very close now to starting, and today's action will take us right up towards the 200-day moving average. So if we can get above that resistance level, that's going to kind of clear the way for the markets to rally higher here. Now, a failure at this point, if we do take out this kind of this building line of support that we have, we're going to have we'll have a decent retracement back. So again, what happens here over the next few days and really kind of couple of weeks is going to be really important for the market. If the market can continue to build support here and start to get some momentum behind it, in terms of the stock market, start to heal up, get past some of this negativity that's been floating around the markets, there is potential here for this market to go ahead and rally some more going into the summer. But if we don't, there's some risk here that we're going to have another bit of a decline. But again, we've got to take out this kind of support line that's getting built here. And again, so this will be something to kind of watch. So again, nothing to be overly concerned about right now, but I would still be a little bit reticent about getting overly aggressive right now until we start to really kind of take out this kind of overhead resistance. And then once you do that, and we take out that resistance, it'll be kind of an easier to add equity risk to your portfolio at that point, because you'll have a lot of that risk of downside corrective action starting to move behind you a bit. But right now we're kind of still stuck in this trading range. So just be mindful of that right now. Kind of manage your risk exposure here until the market kind of decides what it wants to do next. But overall, from a bullish standpoint, the market is healing up. It's starting to look a lot better. Breadth is improving. So that's helping a lot of this kind of market to settle down, get past some of that recent volatility we've had. But that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, it is Thursday. And, of course, yesterday was Fed Day. Everybody's kind of all focused on that for the day. What's the Fed going to say? It was pretty obvious the Fed wasn't going to do anything here. And particularly as we talked about here on the show, after the recent kerfluffle between President Trump and Jerome Powell over cutting rates. You know, Jerome Powell was kind of in a tough spot. If he cut rates, it would look like that he was kind of bending the knee to the administration and not wanting to seem to be overly political. You know, they were kind of in a tough spot to cut rates. So they held rates steady and basically, you know, said, look, employment's doing fine. Inflation's coming down towards target. Really no reason to cut rates here. So kind of everything just kind of played out pretty much exactly as we saw, you know, kind of at the previous meeting. Some minor word changes just to address, you know, kind of tariffs, but, you know, talking about particularly the quarter one GDP number in particular, they made a mention that a lot of that had to do with the net exports, and we've talked about that. If you strip out that whole net export component in quarter one GDP, it was actually a decent GDP report. It wasn't hugely strong. We were probably, you know, maybe 1.5% growth. But again, that whole negative print that had a lot of people worried about recession, it really wasn't recessionary in that overall part. But talk some more about this with Michael Lebowitz. Good morning, Mike. How are you?
Good morning.
Good.
How you doing?
I'm good. I've got lots of things to show you this morning, so just kind of hang along with me.
Okay.
I'm joking. He can't see a thing this morning because our camera's
I'm
broke.
blind.
I'm blind.
I'm stuck staring at myself here.
So, but again, from your view, just anything jump out at you yesterday from the meeting?
Not really. I mean, it was really a nothing burger. Not that we expected anything, but, you know, a couple things that stood out was that the Fed feels like they're in a bind. They are unsure of what's going to happen with tariffs, and they're concerned that the current level of tariffs, which in theory will be negotiated down, is inflationary. And then whether it's transitory inflation or persistent inflation, they're not sold either. So that's a risk to them. And then the other risk is unemployment. They're seeing this weakening in the labor markets. Again, it's not recessionary weakening, but they are weak. And their concern is that the very poor corporate and consumer sentiment bleeds into the hard data. But again, they're unaware of whether that'll happen. And they did note, as we've noted before, that the linkage between sentiment and economic activity has not been as robust recently as it's been in the past. You can look at all the spending in 2022, 21, despite very poor sentiment. So basically the gist, and every question seemed to be the same question with the same answer. It's like, what are you going to do next? And the answer was, we're going to sit on our hands. We feel we're in a comfortable position and we can wait. But if need be, we can act quickly to do something. Now, I think the thing to note, though, is that, so the market's up decently this morning, 60, 70 points on the S&P 500, in theory, because of the UK deal. But I think if you kind of look through what Powell said, he said what surprised us with the tariffs was how high they were. And
it surprised everybody because everybody was expecting 10%, right?
No, that's exactly right. And what I think he kind of told the market was, if tariffs are negotiated lower, that removes or certainly greatly diminishes that inflation risk in their heads. And then they can focus on the economy. Like you said, Lance, let's just say we're growing at 1.5%. That's low, right? I mean, it's not a recession, but it's not our natural growth rate. It's low, and that's because the interest rates are higher than where they should be, given the economy, given where inflation has come down to. So I think if we can get some real tariff deals done, or at least the blueprints for the deals in place and discussions with China, the Fed is comfortable to start lowering rates again. So I think, the market didn't react poorly to what he said yesterday, and it's kind of jumping on its UK news. So I think,
just go ahead and tell us what the UK news is so that everybody knows.
Oh, I'm sorry. They've struck a deal with the UK. We don't know. we don't know what it is.
Just bury the headline there. It's quite all right, Mike. I mean,
well, there's no news. I mean, the news is there's a trade deal with UK. It's a big, beautiful deal. Right. That's all I can tell you. It's big and beautiful. But
what else do you need to know? I mean, if it's big and beautiful, what else do you need to know? That's all we need.
What you need. Here's what's kind of being buried is that the UK we have a trade surplus with the UK.
Right.
So coming to a deal with them should not have been that hard. In fact, we never should have had tariffs on it. It's like, let's just leave it alone. This is what we want.
Right.
So that one, should have probably been expected early, because I think it's our 8th largest trade partner, and again, our 7th largest, and we have a slight surplus with them.
Right.
The ones that get harder are the ones with the larger that we run a larger deficit with, and especially China, because of the thorny relationship with them on top of everything else.
Right. Well, and just real quick on that, Mike. And there's been a lot of focus about trade deficits, and just one thing I just want to remind everybody about is that it's okay to have a trade deficit. There are countries that we should have a trade deficit with because we need stuff from them more than they need stuff from us. So trade deficits aren't necessarily the root of all evil. And the whole goal of this, though, is to build a better trade relationship with these countries that we're going to run a deficit with. We're going to run a deficit with China. We need cheap labor. We need cheap product. We have to, that's how we export our inflation to get deflation, back so that people can buy cheap TVs and those type of things. We're going to run a trade deficit with China. The goal is just to get a better deal where they're tariffing our products going in and we're not tariffing their products coming out. So just kind of trying to increase our exports to those countries and reduce that deficit is kind of the goal here.
Yeah, and that's what we talked about early on.
Sure.
What we really should hope for is fair trade. not equal trade. We don't want to run a basically balanced trade deficit with every country. There are some we need to run a surplus with and some we need to run a deficit with, and that's just due to labor, natural resources, and whatever countries are good at producing or not good at producing, or what we're good at producing or not good at producing. So hopefully, when we get a few deals done, we can see that that's the blueprint for all these deals, and that should alleviate economic fears. Or alleviate some of the economic fears. But you're right, Lance. It's about fair trade and making sure our products, if our products are too expensive, they are. But when you throw a huge tariff on them, it makes it almost impossible for foreigners to buy our products. So at least giving our exporters the ability to sell products on a level playing field.
Yeah, it certainly helps. And again, this is one of the things that's been, the dollar's been under a lot of pressure as of late. And again, it's, Mike, I always have to laugh because every time the dollar comes down a little bit, it's the end of the dollar, the end of the world, relationship. It's the demise of the currency. No, you're imposing tariffs on other countries. And so you are going to extract your currency as the dollar comes down in value. You're going to remove your reserve currency, pull it back into your own country. That's going to create stock market declines because you're pulling money out of domestic assets to pull it back into foreign assets. So foreign assets tend to do better in that environment, which is exactly what's happening here. But once all this stuff gets resolved and there's clarity about trade and tariffs and all these type of stuff, that money flow will reverse and assets will come back into the U.S. dollar again. Because again, you have to maintain that reserve currency for your trade. And so once trade is this trade volatility is resolved or this trade uncertainty is resolved, then the dollar will strengthen again. But we've got to get through this process first.
Right. And if you look at our commentary from yesterday, I highlighted a book called Death of the Dollar. And the summary of it, I haven't read the book, but the summary reads just like the narratives going around today that the dollar's going away. The problem is the book was written in 1968. The year I was born. So, this
youngster.
I'm a youngster. Yeah, this has been going on for 57 years. The same stories, the same rationale. But if you kind of look at what they were writing back then, the dollar is actually strengthened, and it is the only alternative, and that's even more so today than back then.
I know. And I thought it was funny because when they wrote that book, and after you mentioned it to me, I went and read a synopsis on it as well. I had ChatGPT give me a quick synopsis on it, but they were talking about the loss of the gold standard was going to, and this was before Nixon took us off the gold standard, right? And that it was inevitable. We're coming off the gold standard, and that was going to be the death of the dollar, and of course that didn't happen. So. Mike's talking, but I can't hear him, so we'll pick up with him on the other side of the break, and we'll figure out what he's saying as I'm reading his lips. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Talk about, well, why do you own gold? Why own gold? Because if everything collapses, it won't matter anyway. You're not going to survive more than 7 days. I don't care if you've got gold or not.
The Real Investment Show podcast.
You don't know how to go out and forage for food. You don't know how to go out and hunt. You've been sitting around your house watching television with your feet propped up, drinking beer for 12 years.
Same show, your schedule.
Danny Ratliff is one. He's going to survive just fine. He's in South Africa right now. He's out there with a knife and Rambo paint on and stalking predatory animals. He'll survive just fine. My next door neighbor with the drill, he ain't gonna make it. No chance.
At realinvestmentadvice.com.
If economic Armageddon happens, pack it up, buddy. You're done.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows, Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, Mike, just for the break, I was mentioning that, this whole death of the dollar narrative that's been going on since 1968. You were saying something as we were going out, but we had already shut you off so we could wrap up the segment. So I didn't hear what you said. So I'll give you the floor. And he cannot hear. Go ahead. Can you hear me now?
Hear you?
Yeah, okay. Can you hear me now? This whole death of the dollar narrative that's been going on since 1968. You were saying something. So, got it. Done. All squared away. All right, Mike. All right. You have the floor to. Better? Yes. You have the floor to back up what you were I'd ask you, or I'd concluded the last segment talking about the death of the dollar, and then, of course, you were saying something and we couldn't hear you. So here, go ahead. I'll give you the floor.
I don't know. That was ages ago. I forgot where I was going. Basically, the premise of the book, the gold standard, there was still a gold standard when he wrote the book, like you mentioned, and that went away. But the strength of the dollar, or the dollar is the world's reserve currency, the rationale has actually strengthened over time. Because, again, more people have been using, more countries have been using it, more countries are dependent on it, and there's no alternative. And I'm actually going to write a longer article on that book and really I'll read it and I'll dive into kind of their top 5 or 10 rationales for why the dollar 57 years ago won't be around today, and explain why at some point the author will be right. I guarantee you, at some point, the dollar will not be the reserve currency, but it's probably not in Lance and Sinai's lifetime.
Right. And mostly not in anybody currently listening to the show, not in their lifetime. So
right. Well, that's because everyone listening to the show is our age or older.
Probably.
Not in my kid's lifetime. How about that?
There you go. Well, I know, and this is, and again, what it will eventually be will be, obviously at that point we'll be, probably invaded by aliens, so it'll be whatever currency they're using. So, it'll be,
Right.
be that.
The Martian peso.
Exactly. So, all right, we'll just kind of flipping, moves here a little bit. So, with the Fed kind of on hold, not surprising. And one of the interesting thing is, speaking about the Fed and interest rates, the economy is starting to, this is the one thing that we talked about a long time ago, is that, the world has gotten very, very used to, over the last, really 5 years or so, to very, very low interest rates, abnormally low interest rates. And, everybody said, well, when interest rates go up, it's going to cause, economic chaos, and there's going to be another housing crisis and all this type of stuff. And that hasn't happened. As the housing market slowed down, absolutely, because of higher rates. Yes, absolutely, housing has slowed down, but it hasn't crashed. And what's interesting is that we're starting to see the economy in a lot of different areas starting to adapt and normalize to a higher interest rate environment. And while we're talking about higher interest rates, by the way, these interest rates aren't higher. They're higher than they were post-pandemic, which were abnormally low. But we're kind of back to normal interest rates. We're back at a level, you think about interest rates. If I'm going to loan money to somebody for a period of time, especially for 10 years, do I really want to loan money to somebody for 10 years at 2%? Not really, right? A 4% interest rate, a 5% interest rates, even 6% has been historically much more normal for interest rates. So all we've done is brought interest rates back up to normal levels, and the economy is starting to adapt to that. Yes, it's now don't get me wrong, it's certainly applying pressure to the economy, but the economy hasn't collapsed as a lot of people were expecting to happen when interest rates went shooting up. Things are starting to normalize. Inflation's coming down, employment's, is a bit weak here, but again, we're kind of just going through this reversal of all that monetary stimulus that we had back in 2021, 2022, 2023. But, as opposed to a lot of the more bearish narratives about higher interest rates, again, yes, and I'm not discounting that interest rates are higher than they were a couple of years ago, but things are starting to normalize in terms of the economics of things. And again, the longer that interest rates stay at about this level, the more the economy will simply adapt to it. Consumers will adapt to it. Just like consumers adapt to higher prices, they'll adapt to higher prices. And, in 10 years from now, we'll look back and go, man, eggs were cheaper at $7 a dozen, right? Because inflation will continue to rise at 2% a year for the next, 10 years. So 20% higher in 10 years, $7 eggs are going to look awful cheap at some point. So, this is just how the economy works. And a lot of these really bearish narratives that were out there are starting to kind of fall away because the economy is normalizing. But Mike, your thoughts?
Yeah, I mean, one of the counterpoints to that is how much of the normalcy over the last couple of years is because of the stimulus. And it's not just the stimulus, right? The initial spending is a big boom to the economy, but then there's what's called a Keynesian kind of multiplier, and it kind of ripples through time. So we all go out and we buy toilet paper. The shelves are empty. They have to restock. They have to get someone to restock it. There's shipping. There's other reverberations that ripple through the economy over time. So for the last couple of years, even though stimulus was lower than it had been during a pandemic, government spending was still pretty high. And the reverberations from who knows how far back were still rippling through the economy. So I guess what'll be interesting is as we progress forward and those echoes of past stimulus weaken, and they are substantially weaker, how will less government spending, in fact, government spending reduced GDP a hair. That was a negative component last quarter for the first time in a while. How will higher interest rates and lower government spending, and then the tariffs, who knows how that's going to affect things.
Right.
What's the real rate of economic growth with higher rates and lower government spending? And, the problem is our rate of growth was 2.5% kind of before the pandemic. And I think
just to that point, we were at 2% growth since the turn of the century, on average. Right. Sometimes higher, sometimes lower, but on average 2%. So go ahead.
Right. No, and we know that during the pandemic, there was a lot of unproductive debt added to the debt pile. And that debt has to be serviced, and higher rates doesn't make servicing that debt easier. And because it's unproductive, it's not producing income to help pay for the debt. So I think many of the problems that existed before the pandemic still exist. What we really don't know, what economists don't know, what the Fed doesn't know is how much of the stimulus is still playing a role, and what is that natural rate of economic growth. If you look at the Fed's long-term forecasts, if you look at productivity growth, which is an incredible barometer of economic growth, they're both telling you it's kind of 1.6, 1.8%.
Right.
Having 4% interest rates in a 1.6 to 1.8 environment doesn't work.
Right.
Unless we become more productive. And that's
the hope for AI, obviously.
We have argued for ages that the key to strong economic growth, more wealth for the citizens of this country, is to promote productive investment. So, hopefully that can, and this is kind of the gist of my article, is that there are ways around after this tariff that can be very bullish. And, you just have to, unfortunately, there's always something in the markets, right? It's tariffs, it's stimulus, it's COVID. It's something that kind of clouds our judgment. Mm-hmm. And you have to really peel back and look over a longer period of time to look at the trends. Look at the economic growth trends. Look at the productivity growth trends, the inflation trends, and ask yourself what's changed. Was COVID a game changer? Probably not. Was our tariffs a game changer? No. It's, it may reorder trade to some degree, but we're not going to look back and say, oh, things are now completely different on trade. I think it will help. I think that it will make trade more fair, but I don't think it's a game changer. And
And again, the next administration comes in, whoever it is, they can completely reverse all these tariffs in 3 years, right? So, whatever we do with tariffs now, unless they are at some point and this is the one of the mistakes that Trump is making with this, is that he's doing this all through executive order, which won't stand the test of time. He should be doing this through legislation and getting it passed through Congress and making these tariffs part of the legislative process so they are permanent. And then it would require an act of Congress in the next administration to reverse all those tariffs. But now a simple executive order by the next president, whoever it is, if they disagree with them, these tariffs are done.
And it's not even that. They just may not be enforced.
Correct.
Right? The next president may just leave them alone and just say, who cares? Just sell us what you want. Or the next president could say, hey, that was a success. Let's go one step further. So you just don't know what's going to come out. We have no idea who's going to even be in the House and Senate in 2 years, let alone who the president's going to be in 4 years.
Well, no, that's my whole point, though, is that the things that people are assuming, my point is that the things that people are assuming today, they're saying, oh, these tariffs are inflationary. They're assuming they're permanent. And they're assuming they're permanent at 38% or 125% or 150%, depending on which country you're talking about. And that's not going to be the case. And, the permanency of a lot of, and to your point, the things you're talking about, when you look back, all these narratives that come along that we say, oh, this is going to do this to the markets or do this to the dollar or do this to the economy, they come and go. And then everything goes back to kind of the way it was working before, because it's just the flow of money, ultimately, at the end of the day. Come back, we'll wrap up the show with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Just getting ready to kind of wrap things up for the day. Markets are pointing higher this morning, at least right now. S&P's up about 50 points at the moment. NASDAQ's up a bit. Dow's up about 311 points. Kind of looks like today, kind of out of the gate at least, technology is going to kind of lead the way, really kind of on that news about lifting, trade restrictions on chips. That's certainly helping the technology sector. Google took a pretty big hit yesterday on news between Apple and Google that Apple Safari, their browser, is going to be using maybe a different form of AI in terms of doing their search through Safari versus using Google. So Google took a hit yesterday, but that's likely going to be fairly temporary. Google's going to be up today, at least pre-market out of this. So again, you're still seeing a lot of this kind of back and forth about what AI is going to do and who's going to get impacted, who's going to lead, who's going to follow. And this is going to be a narrative we're dealing with for a while because AI is really just starting to gain a lot of traction within the economy itself and has yet to really be put to primary use cases, but that's coming very rapidly. So again, the trick is going to be kind of understanding what companies are going to lead in that development of AI and what's going to lead to the actual end uses and in cases of AI. As you're starting to see this, there was ChatGPT had 210 million searches last month. So I mean, just the amount of people using forms of AI for a variety of different things, whether it's learning to do recipes or create shopping lists or to get life enhancement hacks, etc. One of the kind of the interesting things you can do with ChatGPT as an example is start to put in, things to improve yourself, which is, give me a list of 10 things that I can do to improve myself in terms of, mental acuity or business success, whatever it is. And it will start spitting out. It draws on basically all the self-help books, et cetera else, and it will start spitting out all kinds of things you can do to improve your lifestyle or improve your income or improve your if you're working out, to improve your workout programs, your diets, whatever. So there's a lot of things that are going to be coming to that people are going to use more and more of. So again, kind of figuring out who's going to be the player in those sectors is, going to be important. And yes, there's been a lot of talk over the last, couple of months as the Mag 7 in particular has been under pressure, but it's not surprising. These stocks had huge runs over the last 2 years. NVIDIA's up hundreds and hundreds of percent. And so, yeah, they give up 20 or 30% of that gain. That's a normal correction within this. But again, immediately we go back to narratives. Everybody's like, oh, it's the end of AI. Man, it's not the end of AI. It's just getting started. And, then you step one step beyond that is, okay, great, AI is going to do this. Who's going to lead? Who's going to be the picks and shovels in AI? But then who's going to support the picks and shovels? So then you start talking about energy, you start talking about, data center build outs, all those type of things, and who's going to supply the energy for that, the connectivity, all the wiring, the data. There's so many aspects and layers to this, and cybersecurity on top of that. There's going to be a lot of money to be made over the next few years in AI. It's just going to be figuring out, how to get through this particular little cycle that we're in, and who's going to be the winners on the other side. Mike, your thoughts?
And here's something I was thinking about the other day. I use searches, and we'll include AI in those searches for primarily two reasons. One is to get information. So if I want to, why was the Taiwanese dollar up 5% versus the US dollar, and give me 8 reasons that support that narrative, I use Grok. I really like Grok AI. That's the X Twitter AI. And I get in my opinion, a really good answer, and I can dive into it from there. If I want to go shopping, if I want to say what kind of shoes are best for running, on trails, I would just use regular Google or one of the regular search engines. So the question is shopping versus information. Shopping pays the bills. No one's paying Google or Grok to give me information about the Taiwanese dollar. Someone is paying Google, Nike and Adidas are paying Google to tell me about running shoes. So the question is, will we get this kind of bifurcation of internet search services, and who's going to fund the AI services the AI search services that there's really no inherent advertising in? If you go to Google, it's all advertising now, right? Even if you go you want to fly United Airlines, DC to Chicago, the first 3 aren't even United Airlines.
It's Booking, right? It's TripAdvisor, it's the paid advertisers, yes.
Right. You have to go down about 3 or 4 before you finally get to the United, You can type in Michael Lebowitz, Real Investment Advice article about tariffs, and I'm still not the first one. That's about as clear as you can get.
Well, no, because paid search is in your first 3 recommendations. That's the way it works.
And then below it and on the side, that's it's clearly an advertising site. So I think for purchases, for shopping, for those type of things, that may still be the leader, and that's where the money is, right? It's harder to see where the money is for information services.
Well, now you just hit on the exact point I wanted to get to, which is, if you go back, and I was talking about earnings at the beginning of the segment, and talking about that, we had 11% growth rate in earnings in the first quarter. Well, if you strip down that 11% earnings growth, it all came from 10 companies for the most part, right? Little bit, about 3% of the total of 11% came from the rest of the S&P 500. So, when you want to talk about investing, you've got to talk about investing in the companies that are generating the earnings growth, because the earnings growth is what's supporting the valuations. And as we get back to the end of the day, you may hate NVIDIA for a variety of reasons, but NVIDIA has a very low PEG ratio, price to earnings growth ratio, because they're growing earnings by leaps and bounds in this space, and they're the dominant leader. So again, at the end of the day, when we want to invest, we want to find companies that are growing earnings rather strongly, and that's right now, unfortunately, that's the stocks. It's Google, it's Meta, it's these companies that are generating billions upon billions of dollars in advertising dollars and development dollars that are driving that revenue growth at the bottom line. So, as AI develops, there's going to be more and more companies that will benefit from AI by increasing productivity. And that will certainly help earnings growth for those companies. But it's still going to be, at the end of the day, coming back to who's generating the money. When I'm investing, who's generating the revenue and who's generating the earnings growth. And for right now, that's the top 10 companies in the index.
So, Lance, I'm actually just pulled this up. Google's forward PE, 15.35.
Yeah.
The S&P is what, 23, 24, 22, something like that?
22 as of last week, yeah.
Okay. The PEG ratio, 1.31.
Right.
This is like we talked about NVIDIA a few weeks ago. This is a growth company because they're still going to grow earnings faster than the market rate, faster than the economy, at a value price. That's not to say we hit rock bottom yesterday, but it's rare where you can get a high growth company at a value where it's basically growth and value. Normally something's either growth or value. And when you can find that intersection of growth and value, that's not that common. So the question is Google still growth, right? Can they continue to grow their earnings if they can grow their earnings at the market rate, it's still a good value because they're priced decently below the market. But if they can still grow their earnings above the market rate for a considerable period of time, it's probably a steal, even if they are losing search engine business.
Well, and that's again the impact of the search engine loss that they're going to take, and that's just assuming, right? This is just an announcement from Tim Cook yesterday that they're looking to replace it. Doesn't mean they will, and it doesn't mean that at the end of the day, doesn't have that big impact. Here's a funny number for you. Now, Mike, let me just ask you a question. How many, if you broke the country down between Apple and Android, what percentage of the country do you think uses Apple versus Android?
I bet it's 50-50.
No. 75% are Android users. So even if you break down, if they lose 25% of their search business in Safari, they're still getting 75% of the search business, right? So, that's going to be one, and that's really not just in the U.S., that's globally as well. But that's, so to your point, so when we start to look down into these numbers, say, okay, well, how big of an impact that stock took an $8 hit yesterday, or 8% hit, yesterday, after already declining a good bit from the recent peak. So to your point, things are looking, stock's pretty oversold here. I'm not saying go out and buy Google today. We're just talking about valuation, talking about earnings. You're getting to a point to where value is starting to get represented in stocks that you normally wouldn't consider to be a value stock. And it's kind of just an interesting dynamic that's happening within the market as we speak. And the other thing that we can't forget, Mike, is that we still have the whole passive indexing effect with more and more investors just buying S&P indexes or buying S&P, ETFs or ETFs that own these same stocks in their top 10 weighted holdings. That's just all these inflows that are coming into those stocks as well. So it's kind of they get dual support in a lot of different measures. But that wraps up the show for the day. Thank you for joining us. Be back on Friday, of course, with Richard Russo for Financial Fitness Friday, and we'll be back on Monday. So have a great weekend, and be sure and get subscribed to the newsletter, realinvestmentadvice.com. The Bull Bell Report will be out on Saturday, talking about the S&P slashing of earnings and what it means for the markets. That's this weekend's newsletter. See you back here on Monday. Have a great day.